Hey there, it's John here at Traffic Times Conversion Squared, and welcome to the Google Ads Metrics Masterclass. So this is episode 1 of the Masterclass. There's 3 parts coming to you, and what you're going to learn in this Masterclass is essentially what numbers and metrics you need to know and how those numbers and metrics work together to produce profitable and scalable Google Ads campaigns or Google Ads ads. And so not only does this work for Google Ads, but you can also use it in basically any pay-per-click environment. So for example, Bing Ads or another pay-per-click platform. But we are talking specifically here with Google Ads. And so what this will help you with is if you're somebody who's sitting there and you don't know how much you should be bidding in your ads to be profitable, if you don't feel that your ads are currently profitable but you're not sure why, or if you'd like to make your ads more profitable and more scalable, this masterclass will sort of help you to work backwards a bit and really get back to the basics, because these basics, these metrics and these numbers really sit at the heart of successful Google Ads campaigns and management. And so this masterclass will help you if you manage your own Google Ads, or also if you have your ads managed by somebody else. So whether that's an agency or a freelancer or something like that. Realistically, they also need to know and understand these numbers. And some of these things are things that you are going to have to provide to them. Now, if they don't ask you for these numbers, then they're not doing a good job, right? And the reason is because not understanding your metrics and how they work together to produce results is pay-per-click suicide. So what we commonly see is that where people don't understand their numbers properly, they're bidding too much, they're spending too much per sale, and the result of that is that their Google Ads do not end up being as profitable as they need them to be, or they may even lose money. And so how that manifests itself typically is that we hear people say, oh, Google Ads don't work for my business, they're too expensive, or something along those lines. And that usually is a symptom of that business not actually understanding the right numbers and how to use those numbers and metrics to produce profitable ads. So in this first video, what we're going to do is we're going to look at some of the baseline numbers that you must know when you're trying to sell something with Google Ads. And then we're going to start to look at how those numbers combine to help you work out how much you should be bidding and how much you need to be spending on Google Ads per sale to be profitable. And some really quick and easy ways for you to work that out. In further videos, we're then going to look at, well, what happens when you change some of those equations and metrics and how to scale your ads further while still maintaining profitability, and which metrics within the Google Ads interface you actually need to pay attention to and which are not so important. So we're going to dive right into it right now. The first thing that you need to know is your unit price, right? This is the most basic thing you need to understand before you start running Google Ads. And if you don't already know it, you need to go back and work this stuff out. So your unit price means pretty much the entire cost to make a sale, whether that's a physical product, a digital product, a service, something like that. The entire cost to make that sale, excluding your marketing costs, right? So all of these numbers that we're working on and talking about here are in the context of marketing, not the context of accounting, right? So what we're talking about here is not your net cost. This is your unit price. So if you're selling a physical good, that means taking the cost of the good, the cost of manufacturing if you're manufacturing it, sales taxes, shipping costs if you have those, transaction fees if you're processing payments through, say, PayPal or Shopify or Stripe or something like that. So you add all of those together and that gives you your unit price. If you're selling services, that could be your labor costs, any materials that you're required to purchase or produce in order to provide that service. Once again, transaction costs, sales taxes, all that sort of stuff. You need to total that all together and you have your unit price. And that is the base thing that you need to know for anything that you're selling. Now, once you know your unit price, you then need to work out your single sale profit before marketing costs. So once again, I'm not talking about your net profit here, because your net profit your true net profit would take into account whatever marketing costs you had in order to make that sale. This is your single sale profit before your marketing costs. And we work that out by taking your single sale revenue and subtracting from that your unit price, right? So as a result of that, you have your single sale profit. In the example here, you can see that we've got a single sale revenue of $150. So that's the price that you sold it to the customer. And you're subtracting your unit price, which in this case was $100. So your single sale profit before your marketing costs are taken out is $50. Now, you also need to know your conversion rate, right? So, and the common mistake that people make with working out the conversion rate when they're trying to, work out how their ads are performing is they look at the conversion rate of their website or their online store if you're in e-commerce, or their overall sales funnel. Now, that's okay as a baseline, but it can be a little bit misleading. And the reason for that is that we're focused specifically here on your ads, right? So your conversion rate on your overall business may be higher or lower than the conversion rate of the traffic that's coming from your ads. And so what that can do if you use that broader conversion rate is it can mean that you might end up spending too much, or on the reverse, you may actually spend too little and not be very competitive with your ads. So whenever you can, you need to actually use the conversion rate of the traffic from your ads, right? So you can work that out using the Google Ads platform or whichever pay-per-click platform you're in. That will give you that data if your conversion tracking is working properly. I prefer to use Google Analytics to work this stuff out. But however you track conversions, that's what you need to be looking at. So conversion rate, though, as an equation is your total number of conversions over a given period of time divided by the total number of clicks it took to generate those conversions. So if you've got 10 conversions from 1,000 clicks, you've got a 1% conversion rate. Now, I can hear you probably saying, okay, John, I'm new in online business, I'm new in business, and I don't yet have a conversion rate from my ads. I haven't even started running ads yet, so what do I use for my conversion rate? Well, if you already have traffic going to your store and you've got an existing conversion rate, then use that, right? It's not exact and it's not perfect, but it's going to be relatively close. So you can start off by using that until you do have conversions from paid traffic. If you haven't run any traffic to your business yet and you have absolutely no established conversion rate, then it's usually safest to work off a figure of 1% conversion rate. If you're selling more expensive products or services, then 1% is pretty close. If you're selling something that's a bit cheaper, maybe you're selling physical products in the $0 to $100 range, you're probably going to have close to a 2 or 3% conversion rate as a starting point. So work with that. Now, return on ad spend. This is something that a lot of people in e-commerce talk about, return on ad spend is a good metric to know because in a marketing sense, you use it as a quick and easy way to judge how effective a marketing campaign is, right? So if you know what return on ad spend you need to be profitable, right, you can quickly look at a campaign and say, oh yes, I can see that I need a 10x return on ad spend to be profitable. I look at my campaign, I can see very quickly that campaign is performing at 10x, so I know that campaign is on track from a profitability standpoint. Whereas if I look at that campaign and I see it's only got a 6 times ROAS, then I know that I need to be really getting into that campaign and working out how I can bring down my cost per sale and be profitable. Now, return on ad spend is often confused between marketers with return on investment. Now, return on ad spend and return on investment are not the same thing. return on investment uses profit as part of the equation, where return on ad spend uses revenue as part of the equation. But even Google Ads has this slightly confused. I'm working in the context here of how you typically calculate return on ad spend for marketing platforms, right? So if you are a numbers nut, you love your economics and your accounting, that sort of thing, please forgive me, this is not the technical definition of return on ad spend, but from a marketing perspective, it is. So return on ad spend, how you work that out, it's quite simple. You take your total revenue, you divide it by your total ad spend value. So if you spent $5,000 to generate $30,000 in sales, your return on ad spend would be 6. You may also see that described as 6x or 600%. So Google Analytics in particular, when it calculates return on ad spend in reports in Google Analytics, expresses ROAS as a percentage, whereas other platforms will express it as a whole number or a whole number with a decimal point. So whichever way, 600 means 6. Now, knowing how to calculate your return on ad spend is good, but in and of itself, that's not particularly useful. There's a couple of things you actually want to know for your campaigns. You want to know your break-even return on ad spend. So what that means is the return on ad spend you need to be breaking even on your ads. So the return on ad spend, that's going to mean you're spending $1 and you're getting an amount back. That means you're not making any money, you're not losing any money. Okay? So that's the starting point, right? Working out your break-evens. So for break-even return on ad spend, the equation is your product revenue from a sale, and you could do this off a single sale or you could do this off a number of sales. Your product revenue divided by your total single sale profit, which we worked out a little bit earlier. So if I have my product's revenue, or the sale price of the product, is $1,250 and my single sale profit from that product is $400, then to break even, my ads would need to produce a ROAS of 3.12 or 312%. That would mean that whatever I'm spending on ads, I'm getting back 0. So I'm balancing out, I'm 0. Now, once again, you want to know your break even, right? Because that's definitely the point where you can tell whether you're just losing money or you're not losing money. And that kind of denotes the maximum. You would be spending the maximum you can spend without losing money. What you really want to know, though, is what your target profitable return on ad spend is, right? So what is your target ad spend? Yes, breaking even is okay, and in circumstances you might even target breaking even. But most people, they want to make a bit of a profit off their sales. And so to do that, you need to work out what is your target return on ad spend that will give you the amount of profit from each sale that you want. All right, so to do that, we work out we take once again our product revenue and we divide that by our target profit from each sale. So working off the example that we had before, you had revenue of $1,250 and you would divide that by $200, right? So from our example before, our single sale profit was $400, right? So that was the total profit we'd make off that sale. If I said, right, I'm prepared to spend $200 of that to get a sale, which would leave me with $200 to put in my pocket, my target profit is then $200. So to achieve that target profit, I would need those marketing campaigns to be producing a return on ad spend of 6.25 or 625%. And so once again, that means I need double the return on ad spend that I needed to break even, pretty much. And you can see that here. Now, let's move on. So return on ad spend is great when you're selling a product, right? So it's commonly used in e-commerce. You can use it in other business types as well. But when you're selling a product for a product revenue amount. But let's say you're doing lead generation for a service, or maybe you're trying to get signups onto an email list. You're trying to get people into the top of your funnel, and you're actually doing advertising to get that. Well, we call that lead generation. You're generating a lead, which is not actually producing a sale for you, but it's a lead you get in your books so that you can make a sale to them later, whether that's offline or online via email, whatever it might be. So for a lot of different types of, if that's your goal, to just get leads in the door, then you need to know a number of metrics about the value of a lead, right? So the first thing we want to look at is your lead generation average value per conversion event. So a conversion event means whatever you're getting people to do to become a lead. So it could be downloading a lead magnet like an ebook or a checklist or something like that. It could be signing on to some sort of email form on your website. It could be any number of different things. But we call that a conversion event. Your conversion event it could be calling in on the phone. So phone calling your business. If you've got a service business, that's quite a common conversion event. So to work out our lead value or the value of each lead to our business, we look at the average sale for whatever we want to end up selling them, and we divide that by the average number of leads it takes us to get a sale, right? So if we're selling something for $120 and we know that it takes us 20 leads to produce one sale, so 20 people have to take our conversion event to produce one sale, then we can say that our lead value, the value of each lead, is $6 as a break-even scenario. So taking it from there, the next thing we want to know about lead generation work is our cost per acquisition. So to work out our cost per acquisition or our cost per lead, we look at our total ad spend and we divide that by the total number of leads that we generated off that ad spend. So if we spent $5,000 and got 400 leads into our business, then we know that we're paying $12.50 cost per acquisition, or it's commonly referred to as CPA. So our CPA for each lead is $12.50. Now, going a bit further down the track, and look, just stick with me here if a lot of those numbers seem a bit like, well, why do I need to know that and how does that work? We're going to come back to using each of these things. But before we jump into some actual more media equations, if we look at a bit down the track, or if you've got a business that's already established, right? You want to get to a point where you can look beyond just the results of a single sale per customer. And you want to start looking at what is your customer's lifetime value. Because your customer lifetime value and what that means in terms of profit, etc. for your business can influence how much you're prepared to spend in the first place to get one sale, right? So using a famous example, Starbucks, everyone knows Starbucks, they sell coffee, right? Now, a cup of coffee at Starbucks on average, I think costs something like $4, right? So if Starbucks was only focusing on their marketing, producing one cup of coffee per customer, they can't really spend much money to be profitable on that $4 cup of coffee, right? Well, Starbucks have worked out that actually their customer lifetime value, right, is in the thousands of dollars, because the same customer on average buys from them so many times in their lifetime that they are actually worth thousands and thousands of dollars to Starbucks. And so Starbucks says, right, well, we know that we're going to make this much money off this person over their lifetime, so we're going to spend a lot of money to get them in the door in the first place. They're not talking about just selling that person a single cup of coffee. They're working out their marketing costs based on the fact that they're going to make thousands of dollars off that person. So they might be prepared to spend hundreds of dollars or thousands of dollars even to get that customer in the door the first time, right? And when you've got a more established business and you can see that you have your customer lifetime value, then that changes the whole dynamic of how you carry out your marketing. So to work out the average lifetime value of your customers, you're looking at the average revenue you make per sale, and you're timesing that by the average number of sales you get per customer over time. And so, if your average revenue per sale was $120 and you know that on average customers buy from you 3 times, and it doesn't matter what period of time that's over, it could be over a year, it could be over 2 years, whatever, your average lifetime value per customer is $360. From there, of course, the next question is, well, what is the lifetime profit off that $360? Okay, so to do that, you just take the average lifetime value you just worked out, $360, and minus that from the combined lifetime unit price, going back to our unit price right at the very start. So let's say that was $200 to produce that $360 off 3 sales, then your lifetime profit off that customer is $160, which is obvious. And why is this important? Well, $160 in this particular example is going to be more profit to your business than just selling that $120 product once, right? So if you know you're going to make $160 over time, you might say, well, I'm prepared to spend more to get that customer in the door than I was if I only was going to sell to them once for a lot less money. So this is why it's important as your business grows and over time, you start looking at, do I have a customer lifetime value and profit for my business that is different from what I make off a single sale, right? If your business isn't there yet, don't even sweat about it. Okay, so now we're going to get into the meaty stuff, right? So now you know about your all of the numbers you need to know, right? So those are all numbers you need to know. How do you then use that in your Google Ads context? And how do you use it to work out the things that affect your cost per sale and your profit? Well, the first thing that you want to work out is your break-even CPC, right? How much should you be paying per click to produce a result that means you're not gaining money and you're not losing money, right? Well, the equation for this is BECPC, break-even CPC, equals your average conversion rate times your average profit per sale, right? So these are things we've already worked out. Profit per sale, you know. Conversion rate, you know. Now you can do this on an exact product, right? So in which case it wouldn't be average conversion rate. It would just be conversion rate on that product from your Google Ads traffic times by the profit per sale off that product. As an example, if we have an average conversion rate of 1% and our profit per sale is $200, then our break-even CPC is $2, right? If we are, if we're bidding $2 and that's what we pay, then and our conversion rate is 1%, then and it stays that way, then we're always going to break even on those sales and that advertising. We're not going to gain, we're not going to lose. Now, this does get a little bit complicated, right? What you bid on Google is not what you pay on Google. So let's just get this concept out. So if you bid on Google, let's say you bid $2, your bid in that auction is $2. Now, the way the Google auction system works is that you only pay, while you may bid $2, you only end up paying enough to beat your the next bid below you, right? So if you bid $2 and you're in front of somebody that's bid $1.80, well, you're only going to pay $1.81 because that was enough to beat that person. And you'll see this in your Google Ads interface. If you're looking in there and you see that you're bidding something, you look at your average CPC, it's almost always going to be lower. Not always, but it's almost always going to be lower. If you average this out, and we've looked at this over, hundreds of thousands of dollars in ad spend, or possibly even millions and millions of clicks, right? Generally, what you pay will be 20% less than what you bid on average, right? And we can only work this out as an average. So in our next couple of things, we're going to look at how that reduction in spend versus bid can be factored into our calculations. So now we know our break-even CPC, right? So you know now how to work out what you can bid to not lose money and not gain money. But that's not really always the goal, is it? We want to know, ideally, what our ideal max cost per click is to make profit on our sale. So the equation for this is ideal max CPC equals your break-even CPC times 0.7, right? Now, 0.7, this is a number. We've looked across a whole heap of different accounts, and what we've worked out is that 0.7, a reduction of 0.7 as a multiplier, is generally a CPC number that will be profitable for most businesses, taking into account the fact that you also end up paying less than what you bid. So as an example, in our first example, our break-even CPC was $2. So $2 times 0.7 will give us an ideal max CPC of $1.40. So for most businesses, we know if we bid $1.40, we will be spending less on marketing than we're generating in revenue, and enough less that we'll have profit at the end of the day. But you can tweak these numbers, of course. If you know you need a higher level of profitability, you could take that 0.07 down to 0.5, for example, and that will give you your ideal max CPC in that scenario. So this is really important because now you know where your starting point is. If you know that your break-even CPC is $2, right? That means you can never bid more than $2 if your conversion rate is 1%. So what that means, the implication of that is if you're entering an auction and you know that people are bidding more than $2, then there's no point competing at $2 with a 1% conversion rate because you're going to lose money. You will lose money, right? Similarly, when you know your ideal max CPC, now you know if I want profitability, I cannot bid more than this amount, right? Now we're going to look at how you do become able to bid more than that amount and still be profitable in the next video in this series. Now, what if you're doing lead generation ads? So the ideal max CPC before is about a sale that produces revenue. But what if you're doing something that is about generating leads and it's not going to result in a direct sale at that point? You're just running your ads for the sole purpose of generating leads, of getting people onto an email list, of calling your business, whatever your lead event might be. Well, your ideal max CPC in this scenario is your cost per acquisition target. Remember we talked about how you work out your cost per acquisition earlier, times your average conversion rate times 1.2. So once again, we talked about working out your conversion rate. Now your CPA target is once you know how many how many leads it takes you to get one sale, and how much profit that one sale makes you, you can then work out, okay, well, how much am I prepared to spend per lead to generate a sale? Okay, and that amount per lead that you work out is your cost per acquisition target. So you take that number And in this example, I'm using a CPA target of $14. So, right, I'm saying I'm prepared to spend $14 per lead that comes into my business. I know on the leads that come into my business, my conversion rate is 5%. Now, the 1.2 on the end of this is a multiplier to take into account the fact that whatever you bid, you'll actually pay 20% less on average, right? Because you want your bids to be as competitive as you can. So if you have bids that are set too low, without taking into account that 20% difference, your ads won't be as competitive as they could be. So if we add this multiplier of 1.2 on, it's going to help us bid a bit higher to take into account the 20% drop, right? So our ideal max CPC in this scenario ends up being 84 cents, right? So I know now if on these ads and on the keywords I'm targeting or whatever it might be, if I'm bidding 84 cents at a 5% conversion rate and my conversion rate is steady, then I will produce leads for $14, right? And this is an important number to know when you're doing lead generation ads. Now, what about ROAS? We talked about ROAS before for all the e-com people out there particularly. How do you work out your ideal max CPC to hit your ROAS amount or the amount of ROAS that you would like to hit? Well, if you're already running ads, then here is an equation for you. So you take your average cost per click, where it is right now, right? So let's say you're in a position where you're running ads, but you're not hitting the ROAS that you need, right, at your current conversion rate. Well, you can look at your average CPC of your current ads and multiply that by your current average ROAS divided by your target ROAS, and then once again multiply it by the 1.2 to take into account that 20% difference, and it will tell you where your CPC needs to be to hit your target ROAS. So in this example I've got here, I know my average CPC is already 80 cents. My average ROAS at the moment is 5 or 500%, and I'm not happy with that, right? I know I actually want to hit a target ROAS of 7 or 700% to make these ads profitable, right? So here is my equation. It's 5 divided by 7 multiplied by 80 cents and then times by 1.2, and I end up with a lower ideal max CPC than my average CPC of 68 cents. So I know now if I go into those ads and I change my bid to 68 cents and my conversion rate stays the same, then I will move my ROAS to a profitable level of 7x, 700%. So now you know the basic, if you like, formulas for and the numbers that you need to track to run effective Google Ads. In the next video, we're going to look at then how do those things combine together? How do all those numbers combine together to help you grow your ad account, to help you scale your business up and avoid some of the pitfalls that advertisers fall into on Google Ads that lead them to be unprofitable. Look, if you've enjoyed this video and you're seeing it on YouTube, subscribe. There'll be a button just below the video or in the bottom corner of the video. Hit subscribe. If you're on Facebook, like, share, and absolutely leave a comment. If you're struggling with this stuff, leave a comment. Ask any questions you have at all. I'm always more than happy to grab those for you. We'll see you.